you for being here and welcome to JDC West 2016 tax case presentation. First off, I just want to take some time to thank our judges. First off, we have Kristen Haig from Potash Corp, Ashley Lund from Golden Healthcare Management, Irina Kovrankov from the University of Regina, Dave Nielsen from Collinsboro PQ LLP, and Jill Johnson from Cameco. Competitors will have a maximum of 20 minutes to present. Immediately following the presentation, judges will have a total of 5 minutes to ask the presenters questions. The volunteer timekeeper will show time cards at various intervals to indicate the remaining time and will stop any speaker who exceeds the time limit. No questions, comments, cell phones, or picture taking will be permitted by the audience at any time. The audience will only be permitted to applaud following the question and answer period. The audience is banned from any material that bears the name or symbol of a competing university. And we ask that the audience exit the room immediately following the question and answer period. Competitors, you may begin when you are ready.
Hello, Grace. My name's Adam, and along with my colleagues Brianne and Bryce, we're here from BKP and Company LLP, and we're excited to discuss with you today some of the analysis and recommendations that we have for the tax matters that you brought to our attention. So I've outlined here a brief agenda. It's in your notes, so everyone feel free to follow along, but I'd like to highlight at a higher level what we seek to do today, and this is to provide clear and concise and easy to understand tax information, both for your business and for you personally, and this is something we've been able to achieve excellence in with a number of our past clients, so I'm excited to have this opportunity. The primary issue which we will be spending the bulk of our analysis on today is the future of your consulting practice. Now, you have mentioned that there are a couple of alternatives that you have explored with an expansion into Ontario and so forth, but what we're actually going to present is somewhat of a hybrid of the two, and this will be the bulk of our analysis. However, to support this, there are a number of secondary issues that we'd like to discuss before that, as they either lay the foundation for or support our future analysis. 3 key decision criteria that we have laid out here for our analysis today is tax minimization strategies. We don't want to recommend anything, obviously, that is going to increase your tax burden. We want to have financial prosperity both for the business and for you personally, so our recommendations will adhere to this. And finally, being from Western Canada and having a very firm client base out in Calgary, you have a number of connections that we seek to make sure you can leverage throughout as a consultant going forward. So first off, I'd like to discuss the valuation of your business. Now you had pegged this at about $900,000. I'd like to quickly mention a couple things here, as you can, should you seek to sell this business, you can either sell the assets or you could sell the shares. Now, we have identified that given that this is a consultancy, the assets that you will have accumulated will likely not be very high in value. Most of the $900,000 value that you get here is from you personally as a consultant. So there's a large amount of personal goodwill. Given that you are so active in the business, this personal goodwill we have determined would likely be an active asset, and as such, you'd be eligible for the capital gains exemption upon the sale of the shares in this business. And Brianne's going to touch on that a little bit going forward. You specifically asked us about a loan from ECAN for relocating into Ontario. Now, with respect to this, you could receive a loan from the business to relocate so long as a reasonable interest rate is charged to you by the company. Now, right now, the Income Tax Act defines that reasonable rate. They call it their prescribed rate, and it sits at 1%. So long as the interest that you're paying is 1%, none of this loan would be included in your income. However, should you be paying less than 1%, the difference there between the rate that you're actually paying and the 1% prescribed rate would be included as a benefit. In addition to this, you can actually deduct moving expenses from your taxable income because the move will be 40 kilometers closer to the new place of business. So you're currently in Calgary, moving to Toronto, that's well over the 40-kilometer radius. So there's a number of different fees here that I've outlined that you could deduct, but the final point I'll make on this is that you actually won't pay any tax on the sale of your condo should you choose to move. And this is due to the primary residence exemption. You're exempt from tax there. Another question you had raised with us was the tax implications of a partnership corporate structure or as an owner. So as a partner, you actually have one level of tax, but you will likely be taxed at the highest rate. Now, tax or income earned in a partnership is included in a partner's personal income tax for the percentage stake of which they are active in the partnership. So if you're a 30% equity partner, you would have 30% of the income attributed to you. Advantage of this, however, is that business losses can actually be used against your other income should there be any income in the year. So that is one benefit of a partnership. With respect to the ownership of a corporation, there's two levels of tax. There's the corporate tax as well as the personal income tax paid on a salary or on dividends. So since your corporation right now is actually eligible for the small business deduction, income earned within the corporation is taxed at a fairly low rate. And you're able to actually defer some income tax by leaving money in that corporation should you not need an incredibly high salary in a given year. And again, you could potentially be eligible for a capital gain exemption upon sale. Now, a brief thing, this is a fairly popular tax topic right now in the technological sector, and the reason I bring it up is, as you're a consultant, it would likely be very beneficial for you to be able to present such an alternative to your clients in the energy sector. So, specific investment tax credit I'd like to talk about today is called SHRED, Scientific Research and Experimental Design Tax Credits. So this is something you could present to your clients. It's our gift to you as your tax partners. CCPCs are eligible for a 35% refundable tax credit on up to $3 million of eligible expenditures. Non-CCPCs, 20% non-refundable credit. So just hope that this would be some useful information for yourself as a consultant. Next up, with respect to your retirement, I'd like to discuss your RRSP. So for 2016, your maximum contribution limit is the least of 18% of your employment income, or $25,930. Currently, with a salary of about 120 grand, you'd be under the 25,000 limit, so you'd be paying the 18% there. That would be what you could be eligible to contribute to your RRSP and deduct from your income tax. You can begin drawing from your RRSP or transfer it into another investment vehicle upon your retirement. By the age of 71, it all must be withdrawn. Now, I'd just like to draw our attention back to our primary issue here, the issue of the future of the consulting practice, and invite Brianne to discuss this.
So we have here outlined three alternatives. So you did mention that you have an offer right now from ECAN, and so we'd like to explore that with you into more detail on some of the tax implications there of moving to Ontario and the different rates there that you would see compared to Alberta. We also mentioned that you are looking to expand your operations in your current business, Can Energy. We also have some deductions there that may be available to you as you have some more income in your business that I would like to discuss. And finally, a third alternative that we have come up with today is to possibly explore a contractual relationship with ECAN. So maintain your business in Alberta and still work with ECAN on a contract basis for some tax efficiencies there. So now, looking at our first alternative, we are assuming that you would be an employee and not a partner as you do begin your employment there. So with regards to an employment relationship, there is no risk related to your income. So you are guaranteed that salary. The only risk there is with the bonus, depending on how well you do, and that would be with negotiate with your contract. Now, as you progress, if you do enter into a partnership, there is some risks there related to the income that the partnership earns. So as Adam mentioned, any income to the partnership would be allocated to you on your percentage within the partnership, as well as losses. So there is a potential there of losses as opposed to with the employment with the guaranteed salary there. Now, you have mentioned that there are some things that you may not want to negotiate with your contract, such as the car allowance. So one thing to keep in mind is that there needs to be a reasonable rate based on the kilometers driven. So I have here personal versus business kilometers. So any allowance for business kilometers driven is not taxable. However, any personal kilometers driven, there would be a taxable benefit there included in your income. Now, they also mentioned that they would be a defined contribution plan for you, a 5% contribution plan. So any any contributions made by your employer would actually decrease some of your contribution room that you would be able to contribute. So they use some of your contribution room there. And also one thing I'd like to mention is that right now you are paying, the burden of the CPP and the CPP is solely on you as a shareholder and owner of your corporation, and this would actually be shared between you, Grace, and ECAN. And I'd like to touch on the fact that you also would have to sell your Can Energy Corporation. So as Adam mentioned, you may be eligible for a capital gain exemption. So if you do value your business at $900,000, if you are able to get those contracts, there is an exemption available of $813,600 in 2015. So you would be able to save some significant tax there if it is a qualified small business corporation. And we would have to look into your balance sheet there and look into more detail as to whether or not it does qualify. Now, looking at some of the income that was offered to you by ECAN and some of the tax that you would be paying. So now in Ontario, if you were to have a $280,000 salary, they actually have quite a high tax rate of 53.5%. So there would be a tax payable of about $150,000. So this is significantly more than what you would have to pay in Alberta. Now, if you were to have a 40% bonus, again, the tax rate would be 53.5%, and a tax payable there of $60,000. So this is slightly or significantly higher than Alberta tax. Now, looking at our second alternative, trying to expand into the West and into Edmonton and possibly into British Columbia. So now I would like to mention that there is a deduction available to small businesses. So a 17% deduction at the federal level. So any income below $500,000 is actually only taxed at 11%. So this is available to all CCPCs, and Can Energy does qualify for this. So assuming that you do attain these two contracts, we're assuming that your income will be about $300,000 based on the valuation of $900,000. So you would be able for that small business deduction. And so compared to the 28% federal tax rate, there is a tax savings there for you of $51,000. So this tax savings, the purpose of this deduction is to actually help you increase your cash flows and to facilitate some of the expansion into the West and to really reinvest those tax savings into your business. I'd also like to mention, if you do decide to expand and you do need a loan to expand, any interest on that loan would be deductible in the income of your corporation. And just the CCPC, again, would be paid as you have been paying it by you, Grace. Now, our third alternative that we have proposed for you today would be to have a contract between Can Energy and ECAN. So this would help ECAN in their goal to expand into the West. And also you, Grace, would be able to retain all of your connections that you've made here. Now, being in the consulting business, those connections are very important, and we would like for you have a strong reputation that this would really help ECAN and really benefit both parties here. So you would maintain your corporate status, so you would be eligible to use some of those deductions that I mentioned earlier. So you would be taxed at a much lower rate at the corporate level, and it would allow you for a significant tax deferrals as opposed to the partnership where you would be taxed in the year that the income was earned. So you would perform the client would be billed by ECAN, and you would perform the work. Can Energy, your consulting business, would perform some of the work, and there would be a contract charge there between Can Energy and ECAN. And by pursuing this alternative, you would be able to continue to pursue some of those high-value contracts and continue to pursue some of the expansion that you were looking into in the future. Now, looking at comparatively some of the income between Alberta and Ontario, so if you were to use this contract and to continue to operate as a business, so if you were to look at the $280,000 that you would be paid personally, and we're assuming a 20% tax rate, there would be a tax payable at the corporate level of $56,000. And if you needed to continue to pay yourself $120,000 per year, as it seems that you do need looking at your personal income statement, the tax rate would remain at 36%. And the total tax there is only $99,000 compared to $150,000 in Ontario. So you can see there's some significant tax savings available to you by using this structure. And also, just a note here, there is also a deferral there. So some of the income earned, so we see that there's $224,000 left in the corporation. You're only taking out $120,000 what you would need. So you can reinvest some of that which has been taxed at a lower rate. So this is, again, significant, some deferrals there available for you. Now looking at some of the decision criteria outlined by Adam, as you can see here, accepting the offer of ECAN is not, you're not minimizing any tax. The tax is much higher in Ontario. You would have some financial prosperity as moving to the east and trying to advance your career with the partnership. However, you would lose a lot of your connections here in Western Canada. Now looking at your expansion of your current business, you would be staying in the same tax. There would be some minimization there with a small business deduction as you continue to grow. And you would maintain your connections. However, looking at the contractual relationship, we can see here that there is some tax minimization and tax deferral, also significant financial prosperity, and you are maintaining those connections and really using those connections to work with ECAN to help your business grow and prosper. Which is why we do recommend that you explore the contractual relationship with ECAN. We are really excited about this today, and I would now like to invite Bryce to discuss implementation.
So as you can see, we have our implementation lined up for you here. We'd like to begin with the immediate steps that we'd like you, Grace, to take. Then we'll move on to the short term, and then some more long-term recommendations as you'd asked us to help you out with your retirement a little bit. So getting right into things, the immediate things that we would like you to take care of. Right away, we would like you to engage in discussion with the lead partner of ECAN, Gerard Posner. So what we believe here is that you should put forth our recommendation. The worst that can happen is they decline it, they counteroffer, and we go back to one of the other two recommendations that you had had before. So we believe that we've presented the best for you, as you can minimize a lot of tax and defer a lot of tax by maintaining your corporation, CAN Energy. And then, of course, this is going to allow you to heavily leverage these connections that you've built in the West. So all the clients that you've built up over time, this is something that we'd like you to leverage as much as you can in these discussions. As ECAN is looking to expand, this is, we feel, the pillar that you can stand on, the connections. They're going to allow you and ECAN to achieve excellence as you help them expand into the West. Now, we also believe it's going to be important to communicate these changes to the staff, so acting more, taking on some contract roles with ECAN and helping them out in that variety, helping them expand and take on more work in the Alberta domain. So then looking on to the shorter term, that's going to be the end of January, so February up to September. We'd like you to pursue these two high-end margin clients that you made us aware of. So this is going to help to ensure that your business flourishes, and as you can build more connections, this again helps you with leveraging negotiations with ECAN, and it makes you a more valuable asset to work with them in the future. Now, as you grow, you're going to need to expand as well. So in this time frame, we think it would be beneficial for you to hire perhaps some additional staff, perhaps see if ECAN would transfer some workers out. You can start to build that relationship, really strengthen the bond between the two companies, and show how you can be of value in their expansion to the West while still achieving excellence yourself. Now, as we had mentioned, this will be a contracts type of relationship. So you're going to also leverage the expertise that you've built up in the West and the reputation that your company has built up to try and help ECAN out with some of their current clients and help them to grow their client base to ensure that these connections can be prosperous for the both of you. And then, of course, we're going to recommend that you retain your residency in Calgary. So there's going to be some significant tax if you were to move to Toronto. And then again, the costs of living are a magnitude higher. So we think that it's beneficial for you to stay in Calgary, maintain the home in the West, maintain your company, the residence of your company in the West, and keep your tax at a steady rate, not increase it. Now, looking more at the long-term aspects of our plans for you. So it's excellent you've been contributing to your RRSP. That must be withdrawn at 71, or You can transfer that into a RIF and take it out. You can purchase an annuity and have that pay you out through your retirement. So we want you to be aware of that, that it is a long way, but it's something to keep just in the back of your mind as a note, that right there. We'd like you to contribute to your TFSA when you can, when you have the funds in the coming years, as you continue to prosper. Now, the real retirement exit strategy. So as you have built these connections and helped ECAN prosper in the West, we're going to recommend that you look to sell to them. You can transition your book of clients over to theirs. They're going to be very happy with this, and this is something that you can do when you're discussing negotiations with them in this contract role. As no one can work forever, you're eventually going to want to transition out. This is the ideal way. And with your capital gains exemption, should the company be pure, you're going to have probable tax savings of $179,000. Maybe even there's going to be more as the exemption grows with inflation. Now some risks. ECAN may reject the offer. That's a very real possibility, and if that is the case, we simply look at the other two. We've presented you the tax implications, so that's all there for you to take into account. And then disability, we'd recommend some disability insurance. So in summary, we've presented you with an option that will help you to leverage your connections and achieve excellence, and we're happy to have you here today. We'd like to open the floor to any questions you may have.
Great, thank you, group. So judges, ask away.
In your analysis, you mentioned the investment tax credit, the scientific research, and experimental design. I'm not familiar with that at all, and how relevant is it to my challenges in my situation?
To you as a consultant, it actually could be a very useful key to recommend to your clients. We hadn't actually put it in our presentation more so for you to be able to take advantage personally, but as you deal with these clients in the oil and gas industry, lots of them are likely going to be coming to you to help them start to develop projects that might be SHRED eligible, and this is just a really good thing for you to be able to bring to their attention, and now you also have a group of tax partners that would be willing to help them, those companies specifically, understand how those projects could be eligible for these credits.
What's your recommendation on building a contractual relationship with ECAN? What are some of my main concern is losing control of the Western portion of what I built. What are some of the suggestions that you would use to mitigate me losing control by going into a contract with a big?
Well, by going into a contract with a company like this, and you being the only contractor or partner working in the West, so we still think that you would maintain that competitive advantage, and we don't see it as being too big of a risk, as you are still the one that's providing the services to your clients and to ECAN's clients.
So going back to the contractual relationship, are you envisioning a relationship between my company and ECAN where, like, my only source of revenue, where I contract exclusively with ECAN and where I'm not able to pursue, like, I guess what I'm trying to say is that going to be my only source of revenue, or am I going to be able to do more
Yes,
my own work?
that's a great question. Now, if ECAN was to become your only source of revenue, you may be deemed what is called a personal service business, and that would have some very negative tax implications for you. So in order to avoid that, we recommend very strongly that you maintain your other smaller clients. You have a variety of clients. You can't simply only partake in ECAN work. As well, you have 6 employees, so you need to maintain above 5 full-time employees in order to avoid those negative tax consequences.
Do you think that could lead to a conflict of interest, though, where, you know, like, say I have an existing client that I'm doing services for, that engagement ends, and ECAN maybe doesn't want to contract me to go after that same client for a new project, like, or I guess I'm just trying to understand if ECAN is contracting me and I'm still allowed to go get other clients on the side, isn't that a threat to ECAN that, okay, well, they're paying me to do this, but I can still go after the client across the street?
There's a couple of things that mitigate this.
That way?
Yeah, absolutely. And a couple of things that come to mind are, first of all, ECAN doesn't have a very large presence in the West. So actually, CAN Energy is a great opportunity for them to begin to build some connections in the West. And in addition, what we presented is a very advantageous recommendation for tax purposes. We would strongly recommend that any of these contracts be run past your legal advisors to ensure that you're not going to end up cannibalizing any of ECAN's sales, or make sure that you can maintain the two businesses separately and still take on your own clients.
How does this address my work-life balance issue? It seems like I'm still doing my other job, plus now I have more work.
Well, there would be some reduction in, you wouldn't be fulfilling all of ECAN's employments. You would only be working in the West, so you wouldn't be taking on that full-time job. And there would actually obviously be some negotiation there that needs to be done with ECAN. However, as Bryce mentioned in his implementation, we do recommend that you look into possibly hiring more consultants to help you with that.
Looking again to move, should you actually choose to move to Toronto, a life as a consultant, as you know very well, is highly demanding, and it's rather unlikely that in a busy city such as Toronto, you would end up having much different of a work-life balance than you do in Calgary. And as Brianne had mentioned, hiring some additional support staff would definitely help that out for you.
And that's all the time we have for